Hello, my name is Sebastianus Padmo Agung. I'm studied in India Nusantara University, and student ID number is 121192035. Now, I will discuss about the financial statement. Financial statements are business documents that report financial information about a business entity for decision maker. International Finance Reporting Standard is a standard and interpretation adopted by the International Accounting Standard Board, which include 1. International Finance Report Standards. 2. International Accounting Standards. 3. International developed by the International Finance Reporting Interpretation Committee or former Standing Interpretations Committee. In the financial statements, there is a conceptual framework. This one. A conceptual framework is a coherent system of interrelated objectives and principles that can produce consistent standard and define the nature, function, and boundaries of financial account and financial reporting. The conceptual framework is very important for the development of accounting in general because it is useful for 1. From the basic concept and purpose. 2. Provide a framework for practical problem solving. 3. Increase understanding and confidence for user of financial statement. This is accounting conceptual framework. The first conceptual is qualitative characteristics. Consists of understandable, reliability, relevance, comparability. And then the second conceptual is constraint. Concept of punctuality, balance between qualitative characters, benefit versus cost. The third conceptual is assumption. Consists of accrual accounting, going concern. And last, the fourth conceptual is element. Consists of asset, liabilities, equity, profit, and expense. Element of financial statement. Assets are economic resources controlled by the entity that are expected to generate future economic benefit for the entity. Liabilities are current obligation of the entity that are expected to result in an outflow of economic benefits from the entity. Equity is the residual interest in the entity's assets after deducting the entity's liabilities and represent the residual claims of shareholders on the entity's asset consisting of share capital and retained earning. Profit is the economic benefit during an accounting period. For example, an increase in assets or a decrease in liabilities resulting in an increase in equity. order the those involving transaction with shareholder. In the IFRS framework, separates revenue and profit. Revenue comes from ordinary business activities such as sales revenue, while profit don't come from business activity such as profit on the disposal of the subsidiary. Expense. A decrease is economic benefits of our accounting period. For example, a decrease in assets or an increase in liabilities resulting from a decrease in equity or the involving transaction with shareholders. Constraints experienced in providing information. Punctuality. Information must be immediately available to users to assist decision makers. So that the information that they want become more relevant. Assumption in the financial statement. Assumptions are needed to meet financial report objective, as we must prepare financial reports on the accrual basis. Accrual basis is the process of recording account transaction, where transactions are recording when the occur, when the cash has not been received or issued. On the accrual basis, revenue is recorded when a sale occurs, even though cash has not been received, while expenses are recorded when the cost is used, even though cost has not been issued. Note to financial statement is additional information that needs to be provided regarding various matters directly related to the financial statements presented by a particular entity, such as the accounting policy used by the company and various information relevant to the financial statement. The following of three important things that must be disclosed in relation to the company presenting the report. A. Information about the basis of preparing financial statement and the accounting policy selected and applied to important events or transactions. B. Information required by the statements of financial accounting standards but not presented in the statement of financial position, income statement, statement of cash flow, and statement of the cash in equity. C. Additional information that is not present in the financial but is required for the fair presentation. Notes to the financial statement include an explanation of the narrative or details of the amounts shown in the statement of financial position, income statement, statement of cash flow, and statement of change in equity. Order of notes to the financial statement. Disclosure regarding the basis of measurement and accounting policies applied, supporting information about financial items according to the order in which items are presented in the financial statement and the order in which the components of the financial statement are presented. 3. Other disclosures include contingencies, commitments, and other financial disclosure as well as non-financial disclosure. Thank you. This is presentation about financial statement.